Silver just had one of its wildest weeks in recent history, and if you blinked, you probably missed a good chunk of that move. We're talking double-digit weekly gains, record intraday prices, political curveballs, and a futures market that's starting to look like musical chairs with fewer and fewer chairs left. So, in this video, let's break down what just happened in silver this week, why the market is suddenly acting like it discovered pre-workout, and what to watch next week if you're stacking, trading, or just silver curious. Let's start with the big headline. Silver finished the week up about 11.7%, closing near $89 an ounce after briefly flirting with record highs above $93. That's the kind of move we used to see over months, not days, and it's happening as the market finally wakes up to just how tight the physical silver picture really is. We'll talk COMEX inventory stress, China's new export clampdown, industrial demand from solar, EVs, and AI, and then wrap with a quick outlook for next week. So, grab your coffee, or your favorite silver coin to fidget with, and let's get into it. First up, what is the Federal Reserve doing, and why does it matter for silver? The Fed cut rates in December and now has the federal funds rate sitting in roughly the mid-3s, but the tone lately has been, we're good here, let's just chill and see what happens. Chair Jerome Powell basically said the Fed is well positioned to wait, which is central bank speak for, don't hold your breath for a bunch of cuts in early 2026. Markets have got the memo. Odds of a rate cut at the late January meeting are tiny, in the single-digit to low teens % range, so traders have largely priced in a pause scenario for now. That's been reinforced by stronger than expected U.S. economic data this week. Retail sales for November rose about 0.6% versus expectations closer to 0.4%, and wholesale inflation came in soft but still not low enough to make the Fed panic about deflation. In other words, the economy isn't falling apart, inflation isn't fully tamed, and the Fed feels no urgency to slam rates down. Normally, higher for longer rates are a bit of a buzzkill for precious metals because they increase the opportunity cost of holding something that doesn't pay yield. But this week, silver basically shrugged and said, that's cute, because physical and structural factors are starting to matter more than the traditional macro script. When you see double-digit weekly gains while the market is dialing back rate cut hype, that's a sign the story is bigger than just the Fed. Now let's talk about the COMEX, because that's where the plot thickens. Futures prices ripped higher this week, with front-month COMEX silver ending the week more than 11% higher and having spiked intraday above $93 before a late-week pullback. Volume has been heavy and open interest is elevated, especially in upcoming contracts, which tells you participation is strong and there's real money behind this move, not just a few Reddit posts and a dream. The real drama, though, is in inventories. Total COMEX silver stocks look big on paper, in the hundreds of millions of ounces, but once you break them down into eligible versus truly registered and available, the picture gets a lot tighter. Several analysts tracking warehouse data estimate that effectively unencumbered registered silver is now only a small fraction of total inventory, tens of millions of ounces versus notional futures exposure that runs into the hundreds of millions. That gap between paper claims and readily deliverable metal is what has people using phrases like inventory crisis with a straight face. On top of that, January, normally not the biggest delivery month, has already seen surprisingly strong delivery activity, with tens of millions of ounces reportedly moving in the first days of the year. That's unusual and suggests some players are pulling metal forward ahead of the big March delivery cycle, as if they don't want to wait around and see how crowded the exit door gets. Lease rates for silver have also jumped, meaning if you want to borrow silver, you're paying up, which is another sign physical supply is getting tight. So, you've got futures prices surging, deliveries accelerating, and inventories thinning out. If this were a game of musical chairs, COMEX just swapped half the chairs for folding stools and told everybody to dance faster. Now, let's look at why industrial demand keeps quietly turning the screws on the supply side. Solar is the big headline here. Recent estimates show that solar now accounts for almost a third of all industrial silver demand, and that slice has been growing aggressively. In 2024, silver used in solar panels was around the low to mid-hundreds of millions of ounces and could push even higher as we move toward 2030, especially with the EU and other regions targeting massive renewable capacity additions. The shift to newer, more efficient panel tech like TOPCon doesn't help silver thrift much either, because those designs actually use more silver per panel, not less. So the usual don't worry, they'll just substitute cheaper metals argument runs into physics and efficiency constraints. Yes, manufacturers will try to reduce silver per unit over time, but when performance matters, like in solar, high-end electronics, and advanced power systems, silver is still the star conductor. Then there's the EV story. Silver demand from electric vehicles has been growing, driven by the fact that EVs and hybrids simply contain more electrical components, power electronics, and sensors than old-school combustion cars. Multiple industry forecasts suggest silver usage per EV can be roughly double that of a traditional car, and as EVs gain market share, that adds another steady, compounding pull on silver demand. And we're only at the beginning of the AI infrastructure build-out. High-performance data centers for AI workloads require dense, high-efficiency power delivery and thermal management, and silver shows up in connectors, switches, and high-reliability components throughout that ecosystem. There aren't neat headline numbers yet like X ounces per data center, but the directional trend is clear: AI, cloud, and high-end electronics are not going to be less silver-intensive going forward. Put together, solar, EVs, and tech are turning silver from that shiny thing people hoard into a critical industrial input for the energy transition and digital infrastructure. That's a very different demand profile than the last big silver spike a decade ago, which was driven more by investment hype than structural usage. Now let's zoom out globally, because China just changed the rules of the game. The Shanghai Futures Exchange and the broader Chinese physical market have been trading with a notable premium over Western prices, sometimes several dollars per ounce higher than COMEX, which is way above the old normal spread. That kind of persistent premium tells you one thing: physical demand in China is strong enough that local buyers are willing to pay up, and metal isn't freely flowing out to close that gap. A big reason is policy. Starting January 1st, China implemented new restrictions on physical silver exports, effectively tightening the flow of metal leaving the country. This isn't just a tariff tweak, it's a structural constraint that removes a significant chunk of potential supply from the global pool, especially for Western markets that had gotten used to relying on Chinese refining and exports as a pressure valve. So now, imagine a world where Chinese industrial demand is rising, thanks to solar, electronics, and manufacturing, and at the same time, exports are restricted. That means more silver is being trapped inside China to feed domestic demand, while Western inventories, like those in London, Zurich, and on COMEX, get drawn down with far less help coming from the East. The net effect is that global price discovery starts to look more like a tug-of-war between two partially separated markets, one in China with strong internal demand and policy-controlled flows, and one in the West staring at declining inventories and trying to figure out how to keep the system supplied. That's a recipe for volatility, weird premiums, and the occasional panic bid. On the supply side, the news isn't exactly comforting either. Global silver mine production has been stuck in the 800+ million ounce range for years, down from its mid-2010s peak, and a big part of that is because roughly 3/4 of silver production is a byproduct of mining other metals like lead, zinc, and copper. You can't just flip a switch and double silver output unless you're also willing to ramp up those base metals, and that only happens if their economics justify it. At the same time, demand has been outpacing supply, leading to repeated annual deficits. One recent assessment expects the market to remain in deficit through at least 2026, with cumulative shortfalls over the past several years adding up to hundreds of millions of ounces. Those deficits have been papered over by drawing down above-ground inventories, but that's not an infinite reservoir. Eventually you hit the point where each extra ounce is harder to pry loose. Regions like Mexico and Peru, historically major silver producers, are dealing with their own challenges: lower ore grades, regulatory uncertainty, and political risk. Analysts have warned that without fresh investment and new discoveries, production from some of these jurisdictions could stagnate or decline, even at elevated prices. It's a bit like realizing your favorite buffet has been quietly shrinking the portions every year while raising the price. And then, because markets love drama, politics jumped in this week too. The Trump administration had been reviewing tariffs on critical minerals, including silver, under national security rules, which had some traders pricing in the risk of import disruptions or higher costs. This week, we got a twist. Trump put those specific tariffs on hold, opting instead for negotiations and other tools, which relieved some of that immediate tariff premium baked into prices. That announcement coincided with silver backing off its highs, as some of the speculative froth came out once traders realized they weren't about to see a sudden tariff shock layered on top of everything else. But it's important to note, pausing tariffs doesn't fix the structural supply-demand imbalance, it just removes one extra log from the fire. The deeper issues, tight inventories, export restrictions from China, and persistent industrial demand, are all still very much in play. So where does that leave silver heading into next week? After a week like this, the most likely short-term scenario is consolidation. Some back and forth between roughly the mid-80s and low 90s as traders digest the move and position ahead of the upcoming Fed meeting. Volatility is probably here to stay for a bit. When you combine a structurally tight physical market with a macro environment that can pivot on one press conference, you're going to see big candles. Key things to watch in the coming days are daily reports on COMEX inventories and deliveries, Shanghai premiums versus Western prices, any fresh headlines out of major mining countries, and of course, any new hints from Fed officials leading into the late January meeting. A surprisingly dovish tone from the Fed or a new supply hiccup could be the catalyst for another leg higher. A stronger dollar and very strong US data could give us a deeper correction before the structural story reasserts itself. Either way, silver has clearly entered a new phase where the market is starting to price in more than just its shiny. It's now sitting at the crossroads of monetary policy, energy transition, and geopolitics, and that combo tends to make for interesting charts, and occasionally stressful mornings for shorts. If you found this breakdown helpful, or at least mildly entertaining while you check spot price for the 10th time today, make sure to hit that like button, subscribe to the channel, and turn on notifications so you don't miss next week's silver recap and outlook.